Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal: Ford reveals $900 million tariff hit. $900 million. That's the tariff hit Ford says landed at the very end of the year. And the part that matters isn't just the size. It's the mechanism. This wasn't a competitor out-executing Ford. This wasn't a plant going down. This wasn't an engineering failure. This was a rule interpretation, a retroactive change, and when you're studying business quality, that's one of the most important distinctions you can make, because operational errors are fixable inside the company. Policy counterparty errors are external. They're harder to hedge, harder to forecast, and they change behavior across an entire industry, quietly but permanently. This is the Wall Street Journal on Ford revealing a $900 million tariff hit tied to how the Trump administration applied tariff relief. Ford says U.S. officials alerted the company in December that a tariff relief program announced in October would be retroactive back to November, not all the way back to May as Ford had anticipated. That one sentence is the whole drama. Retroactive to November, not May. And Ford's finance chief, Sherry House, describes it plainly. They were notified very late in the year of an unexpected change. Now, I want to frame why this moment matters. Because this is about incentives. When governments create relief programs, tariff relief, tax credits, rebates, companies allocate capital expecting rules to behave in a certain way. They plan production, they plan sourcing, they plan inventory, they plan pricing. And then, when the interpretation changes, the company finds out what kind of counterparty it really has. The cost isn't just the $900 million. The cost is the loss of planning confidence. And planning confidence is one of the hidden assets that allows compounding. So let's name the central figures in the story. Jim Farley, Ford's CEO. He's the allocator. He's the person deciding where Ford leans in, where it pulls back, and what it chooses to subsidize internally. Then Sherry House, the finance chief. In this piece, she's the person telling you how the math changed and when they learned about it. And then there's the most overlooked decision maker of all, the government. Not as a political entity, as a counterparty that can change the effective economics of your supply chain. Because tariffs are not theory. Tariffs are cost of goods sold, tariffs are margin, tariffs are profit, tariffs are cash flow. Now, the inflection point here is that the tariff hit nearly doubled Ford's anticipated tariff tally. Nearly doubled. So Ford thought it had one number. Then it gets told late in the year it has another number. And it caps a period where Ford posts its biggest ever quarterly loss, $11.1 billion. $11.1 billion, mainly because of previously announced charges tied to Ford's electric vehicle business. And the journal compares that to the prior year. Ford had a $1.8 billion profit in the same period a year earlier. So you go from profit to a massive loss. Now, let's talk about the operating numbers, because we're not here to stare at losses without context. Ford reported quarterly revenue of $45.9 billion, down 5% from a year earlier. For the full year, Ford had an $8.2 billion net loss, down from a $5.9 billion profit in 2024. And full-year revenue rose 1% to $187.3 billion. So you have a company that is still a revenue machine, huge scale, huge throughput, yet the bottom line is being crushed by strategic repositioning and charges. This is the real world of capital-intensive businesses. The income statement is the scoreboard, but the strategic decisions are the game. Now, here's where the EV story becomes the core. Ford announced in December it expected to take $19.5 billion in charges to retrench amid sinking EV demand. $19.5 billion. That's not tweaking, that's a rewrite. And the journal ties it to the wider industry. Together, Ford, General Motors, and Jeep maker Stellantis have now announced more than $50 billion in charges as they pull back on their EV ambitions. More than $50 billion. That's a collective admission that expectations got ahead of reality. That success, early enthusiasm, political tailwinds, investor pressure, may have been carried too far. And then, the business has to pay the bill. Now let's do the decision autopsy, because that's where you actually learn. Decision 1. Tariff planning. What was expected? Ford expected tariff relief announced in October to be retroactive back to May. That expectation likely influenced how they modeled year-end costs. What actually happened? Officials told them in December it would only go back to November. That created a $900 million hit to close out the year and nearly doubled their anticipated tariff tally. Hidden trade-off? When you assume relief, you take less defensive action, less urgency on sourcing changes, less urgency on price adjustments, less urgency on inventory timing. And when relief is smaller than expected, you eat it. Decision 2. EV retrenchment via charges. What was expected? EV demand would support the investments, the capacity, the product roadmap, enough to justify the pace. What actually happened? Demand sank enough that Ford chose to retrench and take $19.5 billion in charges. Opportunity cost? The opportunity cost is enormous. Capital that could have been deployed into hybrids, software, manufacturing efficiency, or shareholder returns gets tied up in an EV build-out that now needs to be resized. And the hidden trade-off is psychological. Once you announce huge charges, you reset the narrative. You may clear the decks, but you also admit that prior planning assumptions were wrong. Now, we have to confront the part that seems contradictory, unless you've lived through earnings season.n. Even with a huge loss and a tariff surprise, Ford's results bested Wall Street's expectations for earnings and revenue, and the company is forecasting bigger profit and improved cash flow this year, plus narrower EV losses. Ford shares rose 1.6% in aftermarket trading. How can that be? Because markets aren't grading you on the absolute number. They're grading you on the delta versus expectations, and on whether the future looks less uncertain than it did yesterday. Sometimes a big loss is good if it's the last big loss, if it signals a reset. Now, I want to bring the on-screen evidence into your mind, because what the viewer sees is what you're anchoring against. On screen, the viewer sees the headline, Ford reveals $900 million tariff hit. Then the viewer sees the hard numbers, biggest ever quarterly loss of $11.1 billion, compared to a $1.8 billion profit a year earlier. Then they see the retrenchment number, $19.5 billion in charges tied to EV. And then the industry number, more than $50 billion in charges from Ford, GM, and Stellantis combined. These aren't just numbers. They're fossils of decisions. They're the record of how capital was allocated under one set of assumptions and then reallocated when the assumptions broke. So what are the lessons? Lesson 1. Policy is a counterparty. If your business model depends on a specific interpretation of a relief program, you are underwriting political execution risk, whether you admit it or not. Lesson 2. Write-downs are the price of speed. In capital-intensive industries, moving early can buy learning, brand, and market position, but it can also create oversized bets that must be reversed at great cost. Lesson 3. Compounding requires stable rules and stable feedback loops. When either the government changes terms late or demand shifts faster than supply can adjust, the compounding machine turns into a volatility machine. Now I'll end with the core question this article forces. What does this $900 million really represent? It represents uncertainty. It represents late information. It represents how fragile planning becomes when your margins are exposed to external rule changes and internal strategic resets at the same time. And here's the sentence to remember. In a capital-heavy business, the fastest way to destroy compounding isn't a bad quarter. It's building a strategy on assumptions that other people can rewrite after you've already placed the bet. Moving to next title, price increases boost Coca-Cola. Price increases, sales volumes, and a revenue number that's up, but still not enough for the crowd. That's the tension inside this Wall Street Journal piece on Coca-Cola. Because Coca-Cola is doing something that, in investing, we treat like a litmus test of business quality. It's trying to hold the line on price, not with a dramatic gimmick, not with a headline-grabbing reset, but with something much more subtle. Packaging, sizes, entry price points. A company like Coca-Cola doesn't just sell sugar water, it sells certainty, it sells habit, it sells distribution, it sells a small moment of pleasure that people repeat millions of times per day without thinking. And when the world goes through years of inflation, that habit gets tested, not because people suddenly stop liking the product, but because the consumer's budget becomes a battlefield. And on that battlefield, the winning companies are the ones that understand incentives at the level of the individual checkout decision. This is the Wall Street Journal. The article is called Price increases boost Coca-Cola. And the key idea is simple. Consumers feel squeezed, affordability is top of mind, and Coca-Cola has responded by offering new package sizes for people looking for lower prices. Now, listen closely. This is not a discount strategy in the way most people think. This is not Coca-Cola saying, "We were wrong, let's mark everything down." This is Coca-Cola protecting the long-term compounding engine, protecting price integrity, protecting the ladder of value by leaders who understand that the true asset is trust and the true enemy is short-term panic. Quincy's role here is allocator and constraint. Allocator of pricing power across markets and packages. Constraint against the temptation to do something dramatic that would train the customer to wait for lower prices. The article puts his philosophy into a line that matters. There's no big reset out there. That sentence is a thesis, because big resets feel good in the short term. They create a narrative of action, but they can destroy the invisible asset, the consumer's belief about what the product should cost. And once you break that belief, you may not get it back. Now let's widen the lens. Consumers are feeling the squeeze after years of inflation. Prices across groceries and housing are higher than a few years ago. Hiring has been sluggish enough that affordability is on consumers' minds, especially in the grocery store. And you can see the competitive landscape shifting. PepsiCo announced it would slash prices by up to 15% on snacks like Cheetos and Doritos, and the company didn't specify plans to change beverage prices. So there's a hint of divergence. One company is leaning into price reductions in parts of the portfolio. Coca-Cola is leaning into packaging and price architecture. That's a different mindset. Now, let's ground this in the numbers, because numbers are where the story becomes real. Coca-Cola reported that increased prices and sales volumes helped lift fourth quarter revenue to $11.8 billion, up 2% from the previous year, but Wall Street expected $12.05 billion. So revenue is up, but below expectations. Then the earnings line, quarterly earnings rose 4% to 53 cents a share. And then the more important investor metric in this piece, comparable earnings were 58 cents a share, above the 56 cents projected by analysts. So it beats on comparable earnings. It misses on revenue expectations. And the stock reaction is immediate and human. Coca-Cola's stock slid 1.5% to close at $76.81. That's markets in miniature. Not just good or bad, but good relative to what the crowd already priced in. Now, one of the most important parts of this article is not even about Coca-Cola's own execution. It's about constraints placed on lower-income shoppers. Starting in January, U.S. food stamp recipients in 5 states have been barred from buying soda with their benefits. And more states are set to follow. That is a structural change in demand access. Not a preference shift, not a brand issue. A rule change about who can buy what, with what money. And again, when you're studying compounding businesses, you always ask, how exposed is this company to outside rule changes? Coca-Cola's response, at least in this article, is calm. Quincy says Coca-Cola aims to have brands and products people want to buy with their disposable income. And he says the impact will be manageable. And that word, manageable, is doing work. Because it tells you management believes the portfolio, the distribution, and the pricing architecture can absorb the shock. Now let's talk about the real craft here, affordability without a price collapse. Chief Operating Officer Henrique Braun says lower-income consumers feel pressure, but Coca-Cola still gained volume and value share in North America. And Coca-Cola has offered new package sizes over the past year for consumers looking for lower prices. In plain language, when a consumer can't justify the big purchase, Coca-Cola gives them a smaller on-ramp. This is the entry price point idea. Quincy spells it out. They can make bottles and cans in all sorts of sizes, and part of the range is affordability and an entry price point. That's not marketing fluff. That is a capital allocation decision disguised as packaging. Because when you change package sizes, you're changing your manufacturing mix, your logistics, your shelf strategy, your promotional cadence, and you're doing it to defend the long-term cash generation of the franchise. Now I'm going to explicitly align with what the viewer is seeing on screen. On screen, you see the article headline, Price Increases Boost Coca-Cola. You see the photograph of Coca-Cola packaging associated with the idea that the company has offered new package sizes for consumers looking for lower prices. And then the key numbers appear in the text. $11.8 billion of quarterly revenue, up 2%, expected 12.05 billion, earnings 53 cents, comparable earnings 58 cents versus 56 cents expected. Stock down 1.5% to $76.81. This is the evidence. This is the scoreboard. Now, the reality check. Here's the uncomfortable truth. Even the best consumer franchises aren't immune to inflation fatigue. Pricing power is real, but it isn't infinite. At some point, you must give the customer a way to say yes again. And Coca-Cola's method, sizes, and price points tells you they're trying to preserve the premium perception while widening the affordability net. It's a strategy built for compounding, not for applause. So, what are the lessons? Now let me answer the core question this article raises. What is Coca-Cola really selling in a squeezed consumer environment? It's selling optionality in the form of choice, a way to buy the brand at a price that fits today's wallet, without destroying tomorrow's pricing power. And I'll finish with a sentence I want you to keep for years. The best consumer compounding machines don't win by cutting price. They win by protecting the customer's habit while protecting the brand's dignity. Moving to next title, BP halts buyback amid overhaul. The buyback stops, and the market immediately marks the stock down more than 6%. That's not noise. That's the market reading a single action and translating it into a story about cash, confidence, and constraint. This is the Wall Street Journal. The article is called BP halts buyback amid overhaul. And if you only remember one thing from it, remember this. When a company suspends buybacks, it is admitting, quietly but clearly, that the balance sheet matters more than the narrative, because buybacks are the most discretionary form of capital return. Dividends are sticky. Debt payments are mandatory. Buybacks are optional. So when buybacks stop, optionality is being rationed. And rationing optionality is what happens when an empire realizes it's stretched too far. Now, let me tell you why this moment matters beyond BP. This is part of a repeating cycle in capital allocation. A company generates cash. Investors fall in love with shareholder-friendly behavior. Buybacks, distributions, a clean story. Then management takes a strategic swing that sounds virtuous, future-facing, and inevitable. And if that swing is ill-timed or under-earning or simply too expensive relative to the cash engine, the company eventually has to retreat. The retreat always looks the same. Less spending, more cost cuts, asset sales, and a new vocabulary. Simpler, more profitable, back to roots. In this case, it's BP's move back toward oil and gas after what the article calls an ill-timed move into renewables that left BP the least profitable of the major oil companies. That phrase, least profitable, matters because profitability is the oxygen for compounding. If you're the least profitable in a commodity-like business with high capital intensity, you don't get to make many mistakes. Your margin for error is the first thing the cycle takes away from you. Now, the central figures. First, Kate Thompson, BP's chief financial officer. In a turnaround, the CFO becomes the narrator of reality. They're the person who must translate ambition into constraints. And in this article, she says the announcement represents a step change in the pace of BP's efforts to strengthen the balance sheet. Step change. That's the CFO telling you, we're not adjusting the dial. We're changing the regime. Second, the leadership transition. The article says, Meg O'Neill, described as an oil and gas veteran who most recently led Australia's Woodside Energy, is set to take over as chief executive in April. This is the human side of strategy. When a company says it is moving back to its oil and gas roots, and then it hires an oil and gas veteran, it is aligning personnel with the new incentive system. That's not symbolic. That's operational. Because leaders tend to allocate capital toward what they understand deeply, and what they've been rewarded for in the past. Now, let's define the inflection point in one sentence. BP is shoring up finances by suspending the share buyback and reducing spending while it tries to become a simpler, more profitable business and reorient toward fossil fuels. That's the pivot. And pivots are expensive, because pivots are admissions that the old plan won't compound. Now, I want to do the capital allocation autopsy, one decision at a time. Decision 1. Suspending the share buyback program. What was expected? Buybacks were part of the quarterly rhythm, cash generation turning into share count reduction, keeping investors engaged with the return of capital story. What actually happened? BP suspended it, the stated reason to shore up finances while overhauling the business. Opportunity cost? you lose the mechanical tailwind of reducing share count. You also risk losing a certain class of shareholder who was there primarily for that capital return profile. Hidden trade-off? You gain something more valuable in a turnaround: flexibility. Because once you stop buying back stock, you can redirect cash to debt reduction, or to targeted investment in the core, or simply to staying out of trouble. Decision 2. Lowering capital expenditure. BP says it is lowering 2026 capital expenditure to no more than $13.5 billion, compared with $14.5 billion last year. What was expected? A company with big ambitions tends to keep CapEx elevated to build future options. What actually happened? CapEx is being capped and reduced. Opportunity cost? Less investment can mean less future production, less growth, less capacity. But in a capital-intensive business, a slightly lower CapEx budget can also mean higher discipline, better project selection, and fewer value-destructive ventures. Hidden trade-off? Cutting CapEx often signals management is optimizing for near-term cash and balance sheet repair, not for maximum long-term optionality. Decision 3. Increasing the cost reduction target. The company increases its cost reduction target to $6.5 billion by the end of 2027, up from $5 billion. What was expected? Cost reduction targets tend to rise when management realizes the baseline cost structure was built for a different world: higher prices, higher growth, or more forgiving investors. What actually happened? They raised the target. Opportunity cost? Cost cutting can damage culture, slow execution, and weaken the organization if it becomes indiscriminate. Hidden trade-off? If executed well, cost reduction is the purest form of self-help in a commodity-influenced business, because you can't control oil prices, but you can control complexity and overhead. Decision 4. Asset sales and balance sheet repair. The article says BP's net debt stood at more than $22 billion in the fourth quarter. But that doesn't include roughly $6 billion of proceeds expected from selling a majority stake in Castrol. It also says BP has agreed to deals expected to bring in more than $11 billion so far, against a target of raising $20 billion by 2027. And the company wants to cut net debt to between $14 billion and $18 billion by the end of 2027. This is the box they are building for themselves. This is a debt box, a target range, a promise to investors. And once you make that promise, the entire organization starts allocating capital differently. Now, let me align what the viewer sees on screen. On screen, you see the headline: BP halts buyback amid overhaul. You see the framing line that the oil major is moving to shore up finances as it aims to reduce spending this year. Then you see the immediate market verdict: shares of BP slid 6.1% in London. Then you see the peer contrast: ExxonMobil and Shell aiming to keep buying back stock at the same pace as last year, while Chevron and Total Energies have signaled they would slow purchases as oil prices weaken. Then you see the hard numerical guardrails: CapEx no more than $13.5 billion. Last year, $14.5 billion. Cost reduction, $6.5 billion by end of 2027. Net debt more than $22 billion. Expected Castrol proceeds around $6 billion, deals totaling more than $11 billion so far. Target $20 billion divestitures by 2027. Net debt target $14 to $18 billion by end of 2027. That's not a story. That's a ledger. Now the reality check. The article says crude prices fell by nearly 1/5 last year before regaining ground in early 2026, amid heightened geopolitical tensions. Energy companies love buybacks when prices are strong. When prices wobble, the buyback becomes a test of balance sheet strength. Some companies can keep the pace. It means the company committed capital when expected returns were not aligned with the cost of capital, or when execution capabilities weren't strong enough, or when the competitive landscape was already compressing margins. Whatever the specifics, the result is the same. The business was left the least profitable among its major peers. And when you're least profitable, you don't get to talk. You have to act. Now the lessons. Lesson 1. Buybacks are not virtue. They are a residual. The best buybacks happen when the balance sheet is strong, the business is healthy, and the shares are meaningfully undervalued. When buybacks happen to mask weak fundamentals, they become a trap. Lesson 2. Leverage reduces strategic freedom. When net debt is more than $22 billion and you're targeting $14 to $18 billion within a few years, you are telling the world that debt is now a strategic constraint. That constraint will shape every project, every acquisition idea, every experiment. Lesson 3. Success carried too far often looks like a fashionable pivot. Companies don't usually break by doing obviously stupid things. They break by extending a good narrative too far until the returns don't justify the capital. Now I'm going to answer the core question the article raises. What does halting the buyback actually say about BP's future? It says BP is choosing survival-grade discipline over story-grade generosity. It says the company is prioritizing balance sheet repair, simplification, and a return to higher return core investments. And here's the sentence I want you to carry for years. When a company stops buying back its own stock, it's not just changing a program, it's admitting that the balance sheet, not the narrative, is now in charge. Moving to next title, OpenAI fires executive accused of bias. When you run the rulebook for a platform, you're not just writing policy, you're writing the business model. And when the platform gets big enough, the policy itself becomes the product. That's the core tension I can't stop thinking about in this Wall Street Journal story. OpenAI cutting ties with one of its top safety executives after she opposed the rollout of AI erotica in ChatGPT. Because this isn't really a story about workplace drama. It's a story about incentives, about capital allocation, about the compounding consequences of decisions made at massive scale. And most importantly, it's a story about what happens when engagement becomes the asset you're trying to monetize. Now let me anchor us in the key fact that hits like a hammer. OpenAI fired Ryan Bayermeister in early January, after a leave of absence, according to people familiar with the matter. OpenAI told her the termination was related to alleged sexual discrimination against a male colleague. Bayermeister denies the allegation, saying it's absolutely false. And OpenAI, in its statement, says her departure was not related to any issues she raised while working at the company. Those are the positions. Those are the facts presented. But what makes this story investable, meaning what makes it useful for a value investor trying to understand business quality, is the timing and the strategic backdrop. Her ousting came ahead of OpenAI's planned launch early this year of a mode that would allow users to create AI erotica in ChatGPT. Adult mode. That phrase sounds small, like a feature, like a toggle. But at OpenAI's scale, a toggle isn't a toggle, it's a strategic choice about what kind of platform you are building, and what kinds of second-order effects you're willing to absorb. So let's identify the central figures, the way I think about them. First, Ryan Bayermeister. In the article, she's described as the vice president leading OpenAI's product policy team. That team develops rules for how people can use OpenAI's products, and helps design the enforcement mechanisms for those policies. So she isn't just a safety person, she's a rule setter. In platform businesses, rule setters are extremely powerful. They are builders because they build the invisible structure that makes the system usable. They are allocators because they allocate what is permissible and what will get suppressed. And they are constraints because they can slow down product expansion when the enforcement systems aren't ready. Second, Sam Altman, OpenAI's CEO. In this piece, he's the strategic allocator of risk. He's the person pushing the boundary of permissible content, defending the move as an effort to treat adult users like adults. That's a philosophy, and philosophies in companies like this become product decisions. Now we get to the inflection point. The article describes internal criticism from researchers who study how some people develop unhealthy attachments to chatbots. They raise the prospect that sexual content could intensify feelings that some people have for AI personas they view as companions. And an advisory council on well-being and AI that OpenAI convenes has also expressed opposition and urged the company to reconsider. So, you have internal friction. Not political friction, governance friction, a disagreement about what the platform should allow and what the downstream harms could be. And Bayermeister, according to people familiar with her remarks, opposed adult mode and worried it would have harmful effects for users. She also raised concerns that OpenAI's mechanisms to stop child exploitation content weren't effective enough, and that the company couldn't sufficiently wall off adult content from teens. That's the kind of objection that, in a smaller company, might simply be part of a debate. But in a company with hundreds of millions of users, it becomes existential, because the question isn't, can we build this? The question is, can we enforce it at scale with real-world adversaries testing the system every day? Now, let's do the capital allocation and decision autopsy, because adult mode is not only a content decision, it's a capital allocation decision in 3 ways. 1. It allocates engineering and product focus. 2. It allocates enforcement resources, tools, moderation, compliance systems, monitoring. 3. It allocates reputational risk. So, what was expected? From the article's framing, the planned mode would permit adult-themed conversation, including sexual topics, for adult users. The expectation behind that is straightforward. Expanding permissible content can drive engagement. And engagement, at the scale of ChatGPT, is a monetizable asset. What actually happened? There was internal pushback. Bayermeister opposed it. Researchers criticized it on the grounds of attachment risk. And Bayermeister was fired. Officially, OpenAI says, not related to the issues she raised. OpenAI told her it was about alleged discrimination. Opportunity cost? If OpenAI slows down or rethinks adult mode, it potentially gives competitors a lane to capture certain users who want fewer guardrails. The article explicitly notes that competitor XAI has found that looser guardrails around sexual content in its Grok chatbot has helped drive engagement. That is competitive pressure, and competitive pressure is an accelerant on bad governance. Because when the competitor shows engagement gains, leadership inside your company starts to feel the pull to match. Hidden trade-offs? If you allow adult content, you increase the complexity of enforcement. You increase the risk that content leaks to teens if your systems aren't strong enough. And you may intensify unhealthy user attachments to AI personas, an outcome that can drive engagement in the short run while creating moral and regulatory blowback in the long run. Now, we need to name the most important incentive shift in the article. OpenAI has drawn more than 800 million users each week to ChatGPT in its campaign to build the most advanced artificial intelligence. And the company now plans to monetize the engagement of those users with advertising. This is where the compounding lens becomes sharp. Advertising monetization changes everything. Because ads reward time spent. Ads reward repeat usage. So when a company moves toward advertising, it must guard itself against building engagement loops that are profitable but corrosive. This is not theoretical. This is the history of the internet. And that's why the adult mode debate is not a side story. It's the main story. Because it asks, what kind of engagement are you willing to monetize? Now let's align this with what the viewer sees on screen. On screen, the viewer sees the headline, OpenAI fires executive accused of bias. They see the core allegation and denial. They see that she led product policy, the rules and enforcement mechanisms. They see that this comes ahead of a planned launch of a mode allowing AI erotica. They see internal critics raising concerns about unhealthy attachments and the intensifying effect of sexual content. They see the claim that child exploitation stopping mechanisms weren't effective enough, and that adult content couldn't be sufficiently walled off from teens. And they see the scale line, more than 800 million users each week. Then they see the business pivot, plans to monetize engagement with advertising. This is evidence. This is motive. This is incentive. Now for the reality check. A company at this scale can't pretend it's a neutral toolmaker. When you have hundreds of millions of weekly users, you are an institution. And institutions are judged not only by what they can do, but by what they choose to do. The article also notes that OpenAI keeps close tabs on competitors and declared a code red in December after the surprising success and growth of Google's Gemini chatbot. That kind of urgency is understandable, but urgency can also be dangerous, because urgency compresses deliberation time. Urgency makes governance feel like friction, and governance, to a compounding business, is not friction, it is the moat. Now, the lessons. Lesson 1. In platform businesses, rules are a form of capital. They compound trust, or they compound risk. Lesson 2. Monetization methods reshape ethics. If you monetize with advertising, you must be extra careful about what kinds of engagement you're optimizing for, because the ad model is indifferent to whether engagement is healthy. Lesson 3. The higher the scale, the less room you have for untested content expansions. At 800 million weekly users, even edge cases become a volume business. Now I'll end with the core question this article forces on any serious investor. What is OpenAI optimizing for? Is it optimizing for long-term trust and durable cash flows built on legitimacy? Or is it optimizing for engagement first and governance later? The article doesn't answer that question directly, but it gives you the ingredients. And the sentence I want you to remember is this. In an advertising world, the most valuable asset isn't engagement, It's the discipline to refuse the kinds of engagement that will eventually destroy trust. Moving to next title, Ferrari expects rise in revenue, earnings. Our order book extends towards the end of 2027. That is not a brag. That is a moat. That is the sound of demand being rationed on purpose. And it's the single line in this Wall Street Journal article that tells you what kind of business Ferrari really is. Because in most car companies, an order book is a relief. It's a hedge against the next downturn. In Ferrari, the order book is the product. Scarcity is the product. Waiting is the product. And when you understand that, the whole economic engine snaps into focus. This is the Wall Street Journal. The piece is titled, "Ferrari Expects Rise in Revenue, Earnings," and it's about a company that is doing something rare in manufacturing. It is compounding brand equity while keeping financial margins high, in an industry that usually competes those margins away. Now, let me tell you why this moment matters. The global auto industry has been living through turbulence. China competition, sluggish EV demand in places that were supposed to be the promised land, tariffs, currency swings, and yet Ferrari sits in a different layer of reality. The article says Ferrari expects revenue and earnings to rise this year, supported by higher margin luxury sports models and demand for customized vehicles. That sentence is the pattern. When the world gets noisy, high-quality businesses don't win by doing more. They win by doing the right mix. They win by moving upmarket. They win by extracting more value per unit, not by pushing more units. Ferrari is the clearest case study of that pattern in industrial form. Now let's talk about the central figure, Benedetto Vigna, Ferrari's CEO. In this story, he is not a founder, but he plays the founder's role, guardian of the core doctrine. And the core doctrine is explicit in the quote, "Demand is managed with discipline in every market," reflecting the exclusivity model. That word, discipline, doesn't mean cost-cutting here. It means restraint. It means Ferrari will not let the income statement bully the brand. In most companies, the allocator's temptation is growth. In Ferrari, the allocator's temptation is also growth. But the discipline is saying, we will not grow in a way that breaks the franchise. Now, the inflection point. The company expects the year ahead to be dictated by new models and higher income from racing activities and its lifestyle business. At the same time, the article cautions that higher investments and currency could drag on earnings. So you've got a company leaning into product cadence and brand adjacency, racing and lifestyle, while acknowledging that investment spend and FX can be headwinds. That is what a mature compounding machine sounds like. Optimistic on the controllables, clear-eyed on the uncontrollables. Now, let's ground it in the key numbers. Ferrari expects full-year revenue of around 7.5 billion euros, which the article says is equivalent to $8.94 billion. That's up from the 7.15 billion euros reported in 2005. So, revenue growth is expected. But here's where the business quality shows up. The margin structure. In the fourth quarter, Ferrari says adjusted earnings before interest and taxes, one of its preferred profitability measures, increased to 513 million euros from 468 million euros, generating a 28.5% margin. And adjusted EBITDA rose to 700 million euros from 643 million euros, generating a 38.8% margin. Let that settle. An automaker with nearly 40% EBITDA margins. That is not good execution. That is a different business. And the article tells you the street had forecasts. Analysts expected adjusted EBIT of 487 million euros and adjusted EBITDA of 669 million euros. Ferrari came in above those figures. Now look forward. Ferrari expects adjusted EBIT of at least 2.22 billion euros with a margin of at least 29.5% versus 2.11 billion euros and 29.5% in 2025. And it expects adjusted EBITDA of at least 2.93 billion euros, with a margin of at least 39%, up from 2.77 billion euros and 38.8% in 2025. So it's not just maintaining margins, it's guiding to sustain and slightly improve at very high levels. Now, here's the part that will confuse people who still think units are everything. Overall shipments in the fourth quarter fell to 3,152 vehicles, 173 fewer than a year earlier. Shipments down, earnings up, margins strong. This is what happens when you sell higher margin models and customization is a meaningful contributor. In Ferrari's world, the unit is not the car. The unit is the relationship. The unit is the brand promise. The unit is the customer who will pay for customization, for heritage, for a very specific identity. Now, the article also makes it clear that Ferrari's product cadence is active. It launched 6 new models last year, including the F80, which began initial deliveries during Q4. And the company has completed the first reveal phase of its first electric vehicle, the loose set to shape deliveries in 2026 and beyond. This is important because Ferrari is entering EVs in a moment when other automakers are pulling back. But Ferrari's entry is different. The article says Ferrari has been largely sheltered from turmoil and can maintain margins because it sells to more exclusive customers. And it notes Ferrari has only recently unveiled details of its first fully electric car at the same time as it scaled back its EV ambitions to focus on more combustion engine models. That's Ferrari's version of evolution. Not ideological, not maximalist, selective, timed, brand consistent. Now, geography. In its largest regional market, Europe, the Middle East, and Africa, shipments were unchanged at 1,550 vehicles in the fourth quarter. Shipments fell 8.2% in the Americas, and they fell 36% in mainland China, Hong Kong, and Taiwan. The rest of Asia-Pacific recorded a 1.7% rise. That 36% decline sounds scary until you read the next part. Ferrari has limited exposure to China, and it has an ambition to keep sales in the country below 10% of overall deliveries because it's a lower-margin region due to high taxes. In 2025, mainland China, Hong Kong, and Taiwan represented 6.9% of overall shipments. This is a crucial capital allocation insight. Ferrari is explicitly optimizing for margin quality, not headline volume. It is willing to constrain itself in a market if the economics don't match the brand and margin profile. That is rare. Most companies are addicted to the biggest market story. Ferrari is addicted to return on brand. Now I want to align what the viewer sees on screen when the visual appears. On screen, you see a photo of the Ferrari F80. The caption tells you Ferrari launched 6 new models last year, including the F80, and that initial deliveries began in the fourth quarter. You're looking at a physical embodiment of capital allocation, because launching 6 models is not a marketing decision. It's engineering resources, supplier planning, manufacturing complexity, dealer and client management. And Ferrari is doing that while managing exclusivity. Then, on screen, you see the numbers in the contrast, shipments down to 3,152 in the quarter, yet adjusted EBIT up to 513 million euros with a 28.5% margin, and adjusted EBITDA up to 700 million euros with a 38.8% margin. This is the evidence that the mix is working. Now for the decision autopsy. Decision 1. Manage demand with discipline. What was expected? Many companies would try to increase shipments when demand is strong to grab revenue. What Ferrari actually does is manage demand, maintain exclusivity, and extend the order book. The opportunity cost is obvious. Fewer cars sold today. But the hidden trade-off is the real asset. The franchise stays intact and pricing power stays unbroken. Decision 2. Product cadence and high-margin models. Ferrari expects the year to be dictated by new models and higher income from racing and lifestyle. That's the firm leaning into the high-margin edges of the brand ecosystem. The opportunity cost is complexity and investment. The hidden benefit is compounding. Racing and lifestyle reinforce the myth, and the myth reinforces the pricing. Decision 3. China exposure and deliberate constraint. Ferrari aims to keep China below 10% of overall deliveries because it's lower margin due to high taxes. That is the company refusing to chase revenue that dilutes margin quality. It's capital allocation as refusal. Decision 4. EV evolution, not EV surrender. Ferrari's first EV, the Loose, is moving through reveals and is set to shape deliveries in 2026 and beyond. But Ferrari is not presenting EV as an all-in replacement of the identity. The article notes it scaled back EV ambitions to focus more on combustion engine models. Even as it unveils the EV, that is balancing future relevance with present brand economics. Now, the reality check. Here's the uncomfortable truth for investors. Ferrari looks easy. It looks like just raise prices, stay exclusive. But it's not easy. It requires discipline in every market. It requires turning away marginal demand. It requires maintaining craftsmanship while scaling product cadence. It requires keeping the waiting list long without letting customers feel exploited. This is a governance system, and in a compounding business, governance is everything. So what are the lessons? Lesson 1. The highest quality businesses treat scarcity as an asset, not as an accident. Ferrari doesn't happen to be exclusive. It chooses exclusivity and then manages the world around that choice. Lesson 2. Mix beats volume. When shipments fall and profitability rises, you are watching the power of selling the right product to the right customer at the right margin. Lesson 3. The best capital allocation is often saying no. No to the wrong markets at the wrong economics. No to growth that weakens the brand. No to chasing the industry's fashion at the wrong time. Now I'll answer the core question this article raises. Why does Ferrari keep compounding when the auto industry keeps breaking? Because Ferrari is not primarily a car company. It is a scarcity company with a manufacturing arm. It is a brand allocator with an engineering culture, and it earns margins like a luxury house while operating inside an industrial category. And I'll end with one sentence I want you to remember for years. Ferrari's real product isn't horsepower. It's the discipline to keep demand higher than supply year after year until scarcity becomes a permanent form of profit. Moving to next title, Blackstone's Schwartzman builds up private foundation. The last, most consequential capital allocation decision you will ever make is where your capital goes when you no longer get a vote. That's what I hear when I read this Wall Street Journal piece about Steve Schwartzman. Not charity, not giving back, capital allocation, governance, time horizons so long they make quarterly earnings look like a rounding error. The article is from the Wall Street Journal. It's titled, Blackstone's Schwartzman Builds Up Private Foundation, and it describes Blackstone Chief Executive Steve Schwartzman, one of the wealthiest people in the world, ramping up his philanthropic efforts, with plans to expand a foundation in a way that could make it one of the 10 largest private foundations in the United States. Now, why does this matter for investors? Because the highest level of business analysis is not, what did the company earn this year? It's, what does the operator optimize for over decades? And for someone like Schwartzman, whose wealth is largely bound up in his Blackstone stake, the decision to build and expand a foundation is a decision about permanence, about reputation, about influence, about how a franchise gets interpreted by history. I want to slow down and name the central figure properly. Steve Schwartzman. Age mentioned in the article, 78. Blackstone CEO. Longtime Republican donor. According to the article, the foundation recently hired an executive director who is expected to oversee Mr. Schwartzman's vision for anticipated philanthropic growth, and this is described in a document reviewed by the Wall Street Journal. So we have evidence of formal planning, not informal generosity, formal architecture. This is where I want to frame the repeating pattern. Founders and empire builders do not stop allocating capital when they stop buying companies. They simply change the vehicle. In one phase, the vehicle is a partnership. Then it's a personal balance sheet. And eventually it becomes a foundation. Because the foundation is a machine that can operate across generations. And once you see that, you realize something. This is not a side project. This is the creation of an enduring allocator. Now, the inflection point in this story is the move from being wealthy to being permanent. The article says Schwartzman and his team plan an expansion of his foundation, expecting it to grow into one of the 10 largest private foundations in the U.S. And it says the substantial majority of Schwartzman's wealth, again, largely bound up in his Blackstone stake, is slated to transfer to the foundation upon his death, according to one of the people. That one line is the key, because it implies a very specific outcome. The foundation becomes the ultimate holding entity for a massive stake of economic power. So let's do the decision autopsy the way we would for a major acquisition. Decision: build up a private foundation designed to become enormous. What was expected? Most ultra-wealthy people donate in smaller pieces, often through donor-advised funds, annual gifts, or headline-grabbing one-time commitments. What actually happened here? The article describes an expansion plan and governance infrastructure, an executive director hire, paired with a stated expectation of becoming a top 10 private foundation by size. Opportunity cost? Capital placed into a foundation is capital that is no longer freely allocable for private consumption or new ventures under the same structure. But the hidden trade-off is massive. A foundation can pursue long-duration goals, can be staffed and professionalized, and can become an institution that survives market cycles and personal mortality. And now we confront the uncomfortable truth embedded in the article. Foundations are restricted by the IRS from explicit political giving, but they can support causes that are ideologically aligned. That distinction matters. It tells you something about how influence works in the real world. Direct politics is one lever. Long-term cause building is another. And cause building can be a compounding machine if it is well-governed and well-funded. The article says the Schwarzman Foundation plans to continue focusing on education, culture, medical innovation, and the impact of artificial intelligence, according to a person, though it notes some flexibility is built in. So we have stated domains: education, culture, medical innovation, AI impact, and flexibility. That's a portfolio. Now we need to talk about the one hard number in the piece that reorients your brain: Schwarzman's wealth. Wealth data firm Altrada pegs Schwarzman as having an estimated net worth in early February of $43.2 billion. Again, the framing isn't rich. It's institution scale. When you're at that scale, your philanthropic vehicle becomes a market participant in its own right. Now let's handle the visuals, because the article includes a chart and it's not decoration. It's evidence. On screen, you see a list titled Top U.S. Foundations by Assets. It's a ranking, a league table, and league tables are always about status, power, and comparison, whether the author admits it or not. You see names that function like institutions of their own. Bill and Melinda Gates Foundation, $77 billion. Lilly Endowment, $62.2. Ford Foundation, $16.8. J. Paul Getty Trust, $16.3. Robert Wood Johnson Foundation, $13.7. The William and Flora Hewlett Foundation, $13.3. The Bloomberg Family Foundation, $11.8. Foundation to Promote Open Society, $10.5. Gordon E. and Betty I. Moore Foundation, $8.8. And below that, you see the source line, Analysis of IRS Filings by the Lilly Family School of Philanthropy for FY2, 023, defined by the foundation on its tax filing, with a note that assets represent fair market value and that some entities might be part of broader foundations or have changed names. Now I want you to really picture what that chart is doing. It's setting the target. It's telling the reader, this is the realm Schwarzman is attempting to enter. When the article says, one of the 10 largest, it's not vague, it's literally pointing at the tier, roughly 9 to 10 billion and up, by that chart, and at the top, the Gates Foundation at 77 billion. This is the mountain. Now, as investors, we should ask, what is the economic logic of wanting that? Here's the logic, as I see it, using only what the article gives us and the incentives it implies. A foundation is a compounding allocator of reputation, a compounding allocator of influence through aligned causes, a compounding allocator of legacy, and because it's an institution, it can build teams, systems, and processes that make the money act with intention. Over decades, that's what business builders do. They build systems that outlive them. The foundation is simply the last system. Now the reality check. There's a temptation to treat this as pure altruism, but sophisticated investors shouldn't be naive. The article itself reminds us of constraints. Foundations can't explicitly give politically, but can support ideologically aligned causes. That means there will always be an incentives question. Which causes get chosen? Who runs the machine after the founder is gone? How tightly is the vision governed? How does flexibility become drift? Because drift is what kills compounding. In portfolios, drift kills returns. In institutions, drift kills mission. Over time will not be determined by the size alone. It will be determined by governance. Which brings me back to the executive director hire. That is the beginning of professionalization. And professionalization is both a strength and a risk. Strength, because it makes execution possible at scale. Risk, because it introduces agency problems. The further you get from the founder's direct control, the more you need structure to preserve intent. Now, the lessons. Lesson 1. Legacy is strategy. People like Schwarzman don't only allocate capital to maximize returns, they allocate capital to maximize permanence. Lesson 2. When the pool of capital is large enough, the vehicle becomes the message. A foundation isn't just a checking account for good deeds, it's a signal of what you want to be remembered for and what you want to institutionalize. Lesson 3. Governance is the true compounding engine. Whether it's a public company, a private partnership, or a charitable foundation, the system lasts only as long as incentives stay aligned and the mission stays protected from drift. And now I'll answer the core question raised by the article. Why is Schwartzman building this now? Because this is the moment when the allocator recognizes the final constraint, time. And the response is to create an allocator that doesn't die. I'll end with one sentence I want you to remember. The market compounds money, but institutions compound intent. And Schwartzman is trying to turn a fortune into a permanent allocator. Now towards last article, U.S. frackers explore shale abroad. American shale producers are in a midlife crisis. That's not my phrase. That's the phrase in this Wall Street Journal, heard on the street column. And it's perfect, because it captures a moment every compounding business eventually hits. The moment when what worked still works, but works less. Not because the people got stupid. Not because the machines broke. Because the best parts of the opportunity set got used up. This article is from the Wall Street Journal. It's titled, U.S. Frackers Explore Shale Abroad. And the premise is simple. The Permian Basin was so prolific that it distracted American producers from looking overseas. Now they're returning. And the reason I care, why you should care as a value investor, is that this is a capital allocation story masquerading as an oil story. It's about inventory, about opportunity cost, about when a business moves from harvesting a home field advantage to hunting for the next field. Now, let me frame the repeating cycle. Every resource-driven industry has a phase of abundance, then optimization, then consolidation, then the awkward phase where the best days of growth are behind you, but the commodity is still in demand. And if demand keeps growing, the system needs new supply. That's where we are. The article says it's too early to call it quits, with oil demand expected to keep growing for a while longer. So producers are doing two things at once. They're squeezing the most out of the acreage they have left, and they're starting to look abroad for shale. That combination, maximize what's left while scouting the next act, is exactly what a mature operator does. Now, the central figures. The headline names are companies and founders, because in shale, personalities matter. In January, shale pioneer Harold Hamm's Continental Resources made its second acquisition in Argentina's Vaca Muerta shale play. It also signed a deal to develop shale fields in Turkey. Another early mover, EOG Resources, got licenses last year to explore shale in the United Arab Emirates and Bahrain. Those are not random actions. Those are management teams admitting, quietly, that the domestic inventory picture is tightening. And the piece puts this in context. Most pure-play U.S. producers have focused on drilling in their own backyard. Only major oil companies like ExxonMobil and Chevron have maintained big footprints abroad in recent years. That distinction matters, because going abroad is not just geology, it's operating capability, it's negotiating skill, it's political risk management, it's supply chain, it's logistics, it's the ability to run a playbook outside your home stadium. Now we get to the global shale framework that the article uses. Back around 2010, American producers explored going abroad. Rob Clark, a U.S. shale analyst at Wood Mackenzie, calls that period Global Shale 1.0. And then the key line. Production in the Permian was so prolific that companies quit exploration abroad. One of the things that killed Global Shale 1.0 was the Permian, Clark says. That's an incredible sentence. Its success carried too far. Its abundance creating complacency. It's the home run making you stop practicing your away game. Now, times have changed. Clark says conditions are ripe for Global Shale 2.0. The Permian Basin is still a gusher, the article says, but the wells aren't as prolific as they used to be. This is where the first visual matters. On screen, you see a chart measured in barrels per lateral foot. It's titled as Average Estimated Ultimate Recovery of Oil per Lateral Length Drilled in the Permian. And it's focused on Permian Wolfcamp Formation wells, including Midland and Delaware basins, with the year referring to first production date. This is a very specific measure, not production per well in some vague sense. Recovery per foot of drilled lateral. In other words, how much oil you get for each unit of drilling effort. That's the efficiency metric that determines the economic quality of inventory. And the chart tells a story of decline. The article says, on average, Permian wells first drilled in 2016 in the Wolfcamp Formation were estimated to produce 65 barrels per lateral foot drilled. Wells drilled last year are expected to produce 46 barrels per foot. That's not collapse, but it's a meaningful deterioration in productivity. and deterioration in productivity is the hidden tax on the future, because the company has to drill more footage, spend more capital, and take more operational risk to get the same amount of oil. That's the first constraint. Now the second constraint? Time. The article cites Andrew McCann, research director at Enverus. Large-cap North American producers hold about 7.5 years of high-quality shale drilling inventory, defined here as inventory that generates 10% returns when the U.S. benchmark oil price is below $50 a barrel. Small and mid-cap producers are worse, about 2.5 years of high-quality inventory left on average. I want you to sit with that. 2.5 years is not a long runway. It's not a plan. It's a countdown. And 7.5 years for large caps is not comfortable either when you're thinking in cycles that can run longer than that. Which brings us to the demand side. The article says the International Energy Agency previously expected oil demand would top out around 2030. But in its latest long-term forecast, it estimated demand for oil and natural gas would continue growing through 2050 if existing policies continue. And OPEC sees oil demand growing even beyond 2050. Then you get the quote that ties it all together from Dan Pickering, Chief Investment Officer at Pickering Energy Partners. We're approaching the point at which we are going to have to find new sources of production. OPEC's spare capacity is starting to shrink. U.S. shale is maturing. If demand keeps growing, where are those barrels going to come from? That is the capital allocation problem, stated plainly. Now, the second visual. On screen, you see a comparison of expected year-over-year change in oil production, measured in barrels a day. One line is the U.S. One line is Vaca Muerta in Argentina, and the article states the key headline number. In the years 2006 through 2030, Argentina's Vaca Muerta is expected to add more than 700,000 barrels a day of production, double the amount U.S. producers are set to add over that period, according to Enverus. That's the move the needle argument. The article says so far, there are two countries with shale basins large and proven enough to move the needle, Argentina and Saudi Arabia. But Argentina is where U.S. producers are looking, because it is more accessible to foreign investors. Now, here's where I start thinking like an investor, not an oil tourist. Going abroad is rational, but it's dangerous. So let's do the decision autopsy. Decision: allocate capital to international shale. What was expected historically? U.S. producers stayed domestic, because the U.S. opportunity set was rich and familiar. And because international shale, the first attempt, had too many basins, too much uncertainty, too much complexity. What's happening now? The domestic inventory quality is maturing. Producers have fewer years of top-notch wells remaining. And the global shale 2.0 inches concept is more targeted and informed. The article says that about 15 years ago, Clark's research team tracked over 100 different shale basins where wells had been drilled or were going to be drilled. Now that list has been whittled down to about a dozen basins. That's learning. That's the industry moving from exploration mania to focused deployment. Opportunity cost? If you spend capital abroad, you risk underinvesting in optimizing domestic assets. Or you risk taking on new execution risks that blow up returns. Hidden trade-offs? International operations come with what the article calls above-ground risk. The piece notes that China and Russia have substantial shale reserves but pose too much above-ground risk for American companies. So the filter isn't geology alone, it's geopolitics, regulatory predictability, contract enforceability, repatriation of profits, security. Now, the article also explains why some companies are structurally better positioned for this move. Major oil companies like ExxonMobil and Chevron have an advantage because they are experts at operating abroad. So does ConocoPhillips, described as the largest pure-play U.S. exploration and production company. Chevron has a sizable position in Argentina's Vaca Muerta and signed a memorandum of understanding to explore in Libya, which holds shale resources. Exxon signed an agreement last year to develop shale in Azerbaijan. Other large producers might draw on experience. Devon Energy and Occidental Petroleum both have histories of operating abroad. Now we come to something the market is already pricing in. The article says global oil producers' shares outperformed U.S.-focused names in the second half of 2025, in part because of concerns around U.S. shale maturity, according to Evercore. And it provides a valuation data point that is worth repeating twice, because it's the market's opinion expressed in numbers. Exxon's and Chevron's average enterprise value as a multiple of forward EBITDA is about 77% higher than the broader basket of American producers. Over the past 5 years, that premium averaged 36%. So the premium widened, which tells you the market is paying more for international optionality, for diversification, and for perceived inventory longevity. Whether that premium is justified is a separate question, but the direction is clear. Now, I want to inject the investor's reality check. The article says producers have been laser-focused on keeping capital budgets tight and cash returns high since the oil price crash about a decade ago. That's been the discipline era, the shareholder return era. But then it gives the punchline. To get ahead in the next cycle, they may need to bring back some of that wildcatter spirit. And that's where the trap lives, because wildcatter spirit is how you create the next leg of growth. And wildcatter spirit is also how you destroy capital when you overpay, overpromise, or underestimate risk. So the real question isn't, will U.S. producers go abroad? They already are. The question is, will they do it with underwriting discipline, or will they do it with narrative discipline? Because the market always rewards the narrative first, and then the wells report back. Now the lessons. Lesson 1. Depletion is destiny. In resource businesses, the inventory quality is the business. When recovery per foot declines from 65 to 46, your future returns change, even if oil prices don't. Lesson 2. Constraints create strategy. When high-quality inventory shrinks to 7.5 years for large caps and 2.5 years for smaller players, the map has to expand, not because management wants adventure, but because the math forces it. Lesson 3. Compounding requires optionality, but optionality has a price. Majors get rewarded because they have the systems to operate abroad. Smaller players can try, but they're walking into a game where capability is as important as capital. And I'll end with the core answer this article pushes toward. Why are U.S. frackers looking overseas again? Because the Permian was so good, it let them ignore the rest of the world. And now the Permian is still good, but not good enough to carry the next decade of demand growth by itself. So they're being forced back into exploration, not as dreamers, as grown-ups. And the sentence I want you to remember, when the best basin matures, the business doesn't die. It migrates, and the winners are the ones who can take their discipline with them. This is Avi. Like and subscribe. On to the next.